Welcome back to Switzer. Last time Gary Stone of Share Wealth Systems was with us, he was 50-50 on the direction of where stocks were heading. But now it's 2 weeks on, and so are his charts pointing to the positive or the negative? To find out, we have Gary in our Melbourne studio. How are you, Gary?
How are you, Peter?
Now, last time we talked, you kind of disappointed me a bit. You know, you were sitting on the fence, but fair enough. If the charts aren't telling you where to go, I've got to cop it. What are they telling you now?
Oh, Peter, I'd like to think I was a bit more than 50-50. I probably would have said more like 75-25.
You were on the positive, I've got to say, but you weren't. No, definitely not. You were more 65-35. No, 55-45, I think.
Okay, well then I'll go a bit more positive than that tonight. I'll go 95-5 for the medium to longer term.
Good.
But in the short term, I think we'll see a retracement in the next couple of weeks. But in the bigger picture, I'm pretty bullish.
Yeah, well, if you listen to my comment tonight, and Anton Tagliaferro from Investors Mutual sees a correction, but Richard Coppelson from Goldman Sachs, he's really charged up in this bull market over the next 6 months.
Absolutely, Peter. When we spoke last, I spoke of the three big reasons that are driving this bull market. Yeah, we've been in a primary bull market now. You can go back to probably the most recently November last year on the S&P 500. So this primary bull market's been in play for nearly a year now. But in the bigger picture side of things, there's three things. We're in low GDP growth, low interest rate environment. In the United States, it's nearly 0%, and of course we're printing money. But there's one fourth one that I didn't talk about last time, which I'll be happy to talk about in a moment when we have a look at some of the charts.
Okay, well, let's pull the first chart up, Gary, and let's start talking to them.
Okay, the first one is the S&P 500 that had a breakout. In fact, if we go back to October last year, a whole year ago, we were talking about secular bull markets and secular bear markets, primary bull markets, primary bear markets, secondary bull markets, secondary bear markets. And at the moment, the key thing here, if you look at the top right-hand corner, and I've been talking about the potential for getting above that top red line, that top resistance line, was where the boundary was to signal, if you like, us potentially moving out of a 13-year secular bear market into a brand new secular bull market. Now, the traits of secular bull markets, if you go back to October 1982, and I'll give you another one, October 32 years prior to that, October 1950. So we're 31 years away from the last time we had a breakout from a secular bear into a secular bull. So 31 years ago, and it was 32 years prior to that. The cycle's pretty close, but the nature of the beginning, the transitioning from secular bear to secular bull, is that we have a pretty big run-up, and I'm talking about doubling, maybe even getting a 100, 150, even a 200% run on an equities index.
Yeah.
Now, I'm not predicting that's going to happen here, but if we turn into that kind of secular bull market, that's potential that could be lying ahead of us.
Okay, for those people who don't understand the charts and some of the lingo that you've been using, Gary, looking at that red line and the breakout, you're basically suggesting that we could have a number of solid years ahead for stocks.
Absolutely. At least at the minimum, I think 18 months, but probably longer. The nature of a breakout into a secular bull market is that it goes for 2 to 3 years. Now, it doesn't go up in a straight line. In 1982. We had a 5-year run until we had the big correction, which everybody calls a crash, the 1987 crash, where it was a 50% retracement. And you'd expect to have a 50% retracement in a secular bull market. Just what the thing that stood out in 1987 was how quickly it happened. And in 1950, the same thing happened. The equities indices there put on 400%. Now, I'm not predicting that's going to happen, and it's going to happen in a flash. But I think people need to start taking this into account. We've got such a negative mindset that, and this is the fourth thing that I think is really a sign, if you like, that we are really in the infancy of this bull run, is that there are very, very, very few, I can throw another very in there if you want,
Yeah, okay.
private investors and mums and dads that are participating in the equities markets at the moment. And that's not just here in Australia, where I think we're far lower, but even in America, very low participation by mums and dads.
Yep. So we're not even in the euphoric stage, and I guess we're just creeping into the optimistic stage.
Absolutely, we're a long, long, long way from the euphoric phase. The euphoric phase is when the cabbies and the kebab man have a view on the market, and nobody's even talking about it at dinner parties yet. In the upper echelons, there are people earning lots of money.
Yeah.
So we're a long, long way from euphoria in the equities markets.
Yeah. I don't know if you noticed, but Richard Coppelson said that when you get a 9 days out of 10 where the Dow goes up, that's a very strong indicator. And he said it doesn't happen all that often, but we've had it happen 5 times this year, and that's why he is very bullish on the market going forward. So that might be something you'd like to hear as well, Gary.
Absolutely. You look at all the indicators around. The other one that I've also spoken about, excuse me, is looking to what the small to mid cap stocks are doing in Australia. There's a little bit of movement in the mid caps and some of the industrials, but none in the resources, the small to mid cap resource stocks in this market. But in America, the small to mid cap stocks, both in the NASDAQ and on the New York Stock Exchange, are flying. That's another trait. Hearing consecutive up days, when you look at your charts, you just see lots of green bars and green candles. There's all the signs are there, but the fear of the last 13 years, and particularly 2008, still hangs in private investors' minds, and it's that fear has a far bigger weighting in their minds than what the upside potentially does.
Yeah, okay. Now you got a second chart. Let's get that up.
We have.
And tell us what that is telling you.
Okay, now the second chart comes to local market, to the All Ordinaries Index. And when we last came on the show, I said we've moved above this. The previous resistance level was 5,200. And we went up and hit 53, came back down to close to 5,200 again. You can see how the price action's gone there.
Yeah.
And now we've broken sharply, above the 5,300 level. You can see the last little tiny horizontal line on the red one in the top right-hand corner is the 5,300 level. We've had a clear breakaway from that. We've nearly hit 54. I know we came back a bit today, but technically, these are strong markets. There's no doubt about that, and I think private investors need to sit up and take note. And if they do have some fears to potential downside, as markets don't go up in straight lines, they should first of all think about how they might protect themselves on the downside if they're nervous. Once you take care of that, then it kind of liberates you to participate in the upside.
Yeah, but also, Gary, if people want to be a player in this market, they might be saying, okay, Gary's alluding to the fact that he wouldn't be surprised to see a retracement, so maybe I'll sit and wait for that retracement and get in. I guess the other philosophy is, well, be prepared to dollar cost average and get in on the low ones, but don't pass up opportunities now.
Yeah, well, we never don't expect perfection in the market. So the people who say I'm going to wait, sure, wait, but if you miss out because it runs up another 100 points on the S&P 500 or another couple of hundred on ours before it has that retracement, then you just got to accept that and wait for that dip to come again. The other way you can play it is to say, okay, well, I'm not going to time it perfectly, but I'm prepared to get in now, being aware, psychologically, just preparing myself mentally that I might have a dip. The market might have a dip. And if I do, then I'm in this for the next year. I'm not taking a 1 day or 2 day, a 10 or 20 day view in this. I'm taking a 365 day view in this, and I'm going to get a method, get a process, follow somebody. I'm not saying myself, anybody out there, and get onto a strategy and get into the market, become a player.
Yeah, Gary, banks and materials, are they still have upside given what you're seeing for the overall market?
The banks, ANZ, new all-time high. Commonwealth Banks, I think, is just a smidgen below, and Westpac a little bit further behind that. And NAB, well, it's been the laggard of the banks for over 10 years now. But they're at upside. I know people get nervous when stocks and indices make new all-time highs. But really, from a trend following perspective, that's the time where you've got to back yourself. And you'll only back yourself if you have a strategy in place to protect your risk. Onto the resources, BHP is starting to get there, and the resource stocks. I know FMG's had a nice run, Fortescue's had a nice run. It's at a bit of resistance now. I think if it does have a pullback, it won't be a big pullback, but that might be an opportunity to buy. But Rio's lagging, but they're coming. The resources are setting up to have a go. BHP, fantastic results. Some of those headwinds and the negativity towards resources starting to dissipate, and the negativity that's been running around on China and it's all over, etc., etc., is also starting to dissipate, and people are starting to say, some columns writers are now starting to say, gee, I think we got it wrong on the China call.
Yeah, not enough of them, mate, but I got to say, I will remind them when they come on the program. Gary, thanks for joining us on the program.
It's a pleasure, Peter.
That's Gary Stone, Share Wealth Systems. If you want to read my thoughts each morning at the close of Wall Street, check out my website, switzer.com.au. And if you have a self-managed super fund, have a look at the switzersuperreport.com.au website. We've got some free day trials for people like you. And if you've got any questions for me or ones you'd like me to put to an expert, email me switzer@skynews.com.au. I'm Peter Switzer. Thanks for watching. I'll see you tomorrow night.